has stopped. Households in the US seem comfortable with how much debt they have. Corporates never really had a lot. So the private sector deleveraging pressure seems to have ended. Now the US will get into the business of fiscal tightening. The problem is we have two very different views in the US about how to tighten fiscal policy. Broadly, we have a Democratic view, which you would say is much more gradual than the average Republican view. But even within the Republicans, there are very divergent views. We have a significant, hopefully, minority within the Republican Party, the people who call themselves the Tea Party, who believe fervently that the reason the US went into recession in the first place, and the reason it is not growing faster today, is because the government is crowding out the private sector. And therefore, the faster you can shrink government spending, and by the way, not coincidentally, the faster you can lower taxes, the quicker the private sector will start to grow again. Now, on a number of levels, this is a complete misreading of data and history. The US recession was not caused by a big fiscal stimulus. US fiscal policy prior to 2008 was actually relatively conservative, small deficits and debt to GDP of less than 50%. The deficit emerged after the crisis and roughly equally in response to a decline in revenues and an increase in expenditures. Also, if you look at the data, the private sector is growing. Consumption growth is a little below the sort of 20-year average growth rate. Fixed capital formation growth in the private sector, ex-residential structures, is actually a little bit higher than the 20-year average. So private consumption and investment growth is reasonably robust. The US economy is growing only about 1.5% to maybe 2%, because government spending is already shrinking at its fastest rate since the early 1950s. And yet the Tea Party wants to cut government spending aggressively, 20% on day one. They want to cut revenues quickly. So they want to take that deficit, which is today 8% of GDP, they want to take that down to zero as quickly as possible. Therein lies the origin of this fiscal cliff. Because if the United States politicians do nothing, the Bush tax cuts, the Obama tax cuts expire at the end of this year. There will be an automatic $375 billion or $400 billion of expenditure cuts that are required to start on January 1st. We will be hit with a 5 percentage point of GDP decline in the fiscal deficit, essentially starting January 1. The private consumption and investment growth this year, if you add that together, is contributing about 3 percentage points of GDP growth. So you offset that with a 5 percentage point decline in essentially government spending, the US will be in recession from day one. So the all-important question for the United States is which path will we choose? The Democratic path of very gradual, maybe too gradual adjustment, the Tea Party path, and I'm using the wrong hand here because they're really on the right end of the spectrum, aren't they? The Tea Party path of very aggressive fiscal consolidation, even if it means we go in recession, or the new Romney path, because Romney himself in the last 6 weeks has suddenly hurried to the middle and is presenting himself as a real moderate. Potentially, we have two very different outcomes for US fiscal policy next year. Aggressive consolidation that most economists think would push the US into recession, and a very gradual fiscal tightening. The problem is we're probably looking at a 50-50 probability for those two outcomes. And it is not up to whether you think Obama or Romney wins the White House. We have to look at who's going to control the Senate, who's going to control the House, and within the Senate and within the House, how many Tea Partiers are going to win their seats and how influential will they be. Remember, Romney wants us to think that he's a middle-of-the-road moderate on fiscal policy, but his vice presidential candidate is the flag bearer for the Tea Party. So there is all kinds of political uncertainty. We will not know how this plays out until, at the earliest, November 7th, quite possibly December 31st. The consensus view overwhelmingly in the US, and it is our view as well for the sake of forecasts, is that since no president, whether re-elected or newly elected, would want immediately to plunge the economy into recession, that there will be a compromise between November 7th and the end of December. Inconveniently for that president, though, it will be up to what the Americans call a lame duck session of Congress between November 6th and January. And many of these Congress people and senators will have just lost their elections. They may not necessarily share the same kind of loyalty to the new president or even their own party heads. So the political risk that we face emanating from the US because of these very divergent views on fiscal policy is much greater than you would think if you just looked at everybody's forecast for the US economy. Not only is fiscal policy in doubt, but monetary policy is also highly contentious. The Tea Party view is that Bernanke is at least as bad for the US economy as fiscal deficits. They would want to replace him yesterday. Romney has said he will not renew Bernanke's contract, so we will have a new, potentially, Fed governor in 2014. To be honest, Bernanke will probably retire then anyway. But you have, in the Republican Party, a clear bias towards raising interest rates much earlier than 2015, where it would be not unreasonable to characterize Obama and the Democratic Party view as being quite happy with the Fed's current stance that rates will stay near zero until middle of 2015. The possibility, so whereas the markets are, it seems, encouraged by the possibility that Romney may win the presidential election, in our view, investors are forgetting that that would mean interest rates go up a lot earlier than if Obama is president. There is much more risk in US equity markets, for example, from a Romney election than might be imagined. Now, there's another point here with respect to monetary policy I want to touch on briefly, and that is this issue of whether quantitative easing has mattered, whether it has helped, what the impact is on the rest of the world. And there's a lot of very fuzzy and I would argue illogic going on in the popular debate. It is very common for me to hear investors say that quantitative easing had almost no impact on bond yields, but it's a real problem because it prevents bond yields from rising. If you think QE has not had a big impact on bond yields and therefore hasn't had a big impact on growth, then removing QE wouldn't have an impact either. Our view is that actually quantitative easing has had a significant impact on lowering bond yields. And therefore, the removal of quantitative easing is potentially very dangerous for the economy. No central bank has ever successfully ended quantitative easing. The BOJ tried in 2006 and had to start again. Arguably, the Fed in 1935 was engaged in something that looked like quantitative easing, and when they stopped, the economy went back into recession in 1936, 1937. So the fate of quantitative easing is, for us, equally important. Given that we think QE actually did have a significant impact in lowering bond yields in the US, we would argue between 1.5 and 2 percentage points during the QE1 and QE2 phase, then the chorus of complaints that I hear from Asian central bankers about how terrible QE is for Asia, because all it does is unleash a flood of liquidity into Asian capital markets, is equally flawed. QE has been, we think, important in maintaining the recovery in the US, and in Asia, for a region of very export-sensitive economies, that has been very important in preventing a much worse economic outcome than we've experienced. And if Asian central banks think that they are being hit with waves of hot money, and to be honest, we haven't seen waves of hot money for the last couple of years, but if they think that is something they're experiencing, then there is nothing in QE that stops Asian central banks allowing their exchange rates to appreciate. After all, quantitative easing is printing US dollars. If Asian central banks don't want to do the same, then we should expect Asian currencies to appreciate. So my take on QE from an Asian perspective is that I'm very glad we've had Bernanke in office, because quantitative easing was necessary to maintain some kind of growth in the US. That has helped cushion the blow in Asia, and I see very little downside to QE in Asia. But it does raise an issue about the exit strategy for the Fed, for the Bank of England, for the ECB. Deeply ingrained in economists' psyches is a fear of what happens when central bank balance sheets grow as quickly as they have. The Germans still remember in the 1920s that when the Reichsbank was printing money like crazy, eventually we had high, then hyperinflation. Now, the Reichsbank's balance sheet grew thousandfold in the space of a year or two. And in fact, at the height of the hyperinflation, it was growing 1,000% every couple of months. We've seen the Fed balance sheet rise fivefold. So there is an order of magnitude difference between 1920s hyperinflation and what we've seen. But still, most economists would look at what the Fed, the ECB, and the Bank of England have done and be very worried that someday in the future we're going to have very high inflation, 6, 7, 8%. Again, looking at this from an Asian perspective, I think people are slightly missing the point. What matters for inflation is whether that liquidity, which today just sits on the central bank balance sheet, whether that liquidity gets converted into credit and generates demand for goods and services that becomes very inflationary. The PBOC's balance sheet grew fivefold between 2002 and 2011. And through that period, except during the worst of the food shocks in 2008 and 2011, non-food inflation was less than 1%. China struggles to have core inflation, and yet its balance sheet, its central bank balance sheet, has been growing fivefold over a period of 10 years. So it's a similar magnitude increase that the Fed has done over a longer period of time. The secret in China was that China sterilized 90% of that balance sheet expansion. They locked up the liquidity in reserves that the commercial banks were required to hold at the PBOC. They issued PBOC bills and bonds to lock up liquidity. And over the last year, they have quietly been reversing that sterilization as these external surpluses have disappeared. So the key to unwinding quantitative easing is to do it gradually, to avail yourselves of the instruments the PBOC has, required reserves for commercial banks, central bank bills and bonds, or potentially government bonds that are stuffed into banks, to mop up liquidity as banks start to shift excess reserves, which is cash on the balance sheet of the central bank, and shift that into the hands of the private sector. So all is not necessarily lost. QE is not necessarily inflationary unless central banks allow it to be. Now let me end then with China, because what I've just said is rather more complementary to PBOC policy than, in my experience, most other people would be prepared to say. Where are we on China today? Well, where we are is a very comfortable place, to be honest. And I think the hardest thing for investors to understand about China is that when a year ago Premier Wen said that they were going to target growth of 7.5% to 8% this year, we should have believed him, and we didn't. Most people like me sort of sat there and thought, well, when I moved to Hong Kong in 1997, the target was 8%, and you grew 10% for 20 years. So now you say the target is 7.5%, so maybe the target really is 9%. It turns out the target really was 7.5%. The economy has slowed down very gradually. 7.8% year-to-date growth. Tomorrow we will get Q3 GDP. The consensus is 7.3 or 7.4. This economy is very gradually slowing down. 7.5% average growth for this year looks like a very reasonable expectation. We're actually slightly higher than that. So the problem for investors is that they kept waiting for stimulus that didn't come because they had no intention of providing stimulus, because they were actually comfortable with what was happening. In the Chinese policymakers' minds, 10% growth brought pollution, it brought corruption, it brought inequality, it brought discontent. 7.5% to 8% growth will bring a harmonious society, as Hu Jintao calls it. Growth at all costs, transitioning into a concern about the costs of growth. Now, having said that, China's not growing 7.8%. Quarter-on-quarter annualized growth in the first half of this year was about 6.7%. Q3 growth we think could be a little bit better, maybe 7% quarter on quarter. So